What I'm going to talk about today is credit spread mastery. And I use this selling premium technique to generate monthly income month after month. Now, you do have some losing months. Anybody that says you don't have losing months, you better run the other way, because losing is part of this game. However, I keep the losses under a certain percentage control. I actually know when I'm going to exit before I enter, and I think keeping those rules in mind makes a lot of sense. Again, my name's Dale Brethauer. I've been trading for actually 35 plus years now. Hedge fund manager, and I do run with my son a stock education website, www.optionsinfinity.com, and we've got a special offer for you at the end of this presentation. My agenda today is the first 10 minutes probably is going to be a review for some of you, but for some of you that don't even know what a bull put and a bear call are, I'm going to be talking to you about what vertical spreads are. Then we'll get into the meat and potatoes, how you make money with these, what's the best credit spreads to pick, which is the best stocks to watch, how I mitigate the risks, and then I'm going to be going over some actual trades. And these are recent trades. Last month in the RUT, we had a bull put that made $1,050, and that was a June bull put. Then we had a bear call on Amazon, $750 profit in that, and then we had an iron condor that is currently on Amazon, and as of yesterday we were up 700. Well, today we're up 1,200, and that is still open. I'm going to go over some long-term trading results, and these are not things that I did. This is one of my mentees actually went back and back tested this strategy for over 10 years, and I'm going to be presenting his data to you. I'm also going to be showing you current data from what I did a double up challenge last year, and we earned about 150% in a year. Last slide, we talk about generating income and financial freedom. And then I'm going to talk to you about an outstanding offer I have for you today. Okay, the time value of options rapidly decays during the last 30 days before expiration. And this gets exponential as you get closer to that expiration. And what we're trying to do is take this theta decay and put it on our pockets. Okay, it's selling premium. You know, if you go into a casino, you're not playing roulette, you're the house. We're the house when you sell premium. It's a strategy that a lot of professionals use, and it's what I believe is the best and easiest way to generate income on a monthly basis. Now, I do have the question box up. And as I go through, if you have any questions, I'm not going to wait to the end to answer them, because I don't want you sitting there thinking about a question and not listening to the rest of the presentation. So go ahead and type your question into the box. I got it up in front of me. If I see something come through, I will stop and try to address that right then. The advantages of this strategy. One, you don't need to know the market direction. It's kind of nice to know the general direction, but with these strategies, you pretty much don't have to know the exact direction. You can profit when markets are going up or come down. It yields monthly income on a consistent basis. These are high probability trades. You don't have to constantly be watching the market. You don't have to sit there all day long and watch little bars go up and down on your screen. You can pretty much touch base with the market a couple times during the day, and that's it. It's a low anxiety trading strategy. It's something that at nighttime you're going to be able to sleep well, because it's not going to make a big change between one day or another. It slowly works. Now, Steven's saying he doesn't see the slides. Does everybody else see my slides at this point?
Coming through great on my end, Dale.
Okay, so I'll just continue on, Stephen. I don't know what it is on your end. But okay, thanks, Jack. Um, the trades aren't concentrated on a certain price level. We don't have to zero rate in on today's price. And it has great return with controlled risk. Okay, the strategies to take advantage of the theta decay while keeping the risk in check are: the first thing that I look for is to sell an iron condor. Well, an iron condor is nothing more than a bear call spread plus a bull put spread. These are vertical credit spreads. Okay, they're interchangeable names. And let me go through those. First of all, what is a bull put spread? Let's say you think that the market is going to either, from this point here, is either going to go up or go sideways, okay? And maybe even come down a little bit, but stay within a certain range. A vertical spread, a bull put, is what you're doing is you are coming down here and you're selling an out of the money put. And then you are buying one further out of the money for protection. Okay, and this is an example on the RUT, and this is a recent example when the RUT was sitting at 1238. What we did is came down here, and what we did was sell a 1210 put, and then we bought a 1200 put. So you get a net credit. And what you're looking for on a bull put spread is to stay above this level. And the longer it stays above this level and the closer it gets to expiration, the more the premium decays out of there. Okay? Remember, what you're doing is you're selling pretty much a deep out of the money put. And the only options are made up of intrinsic value and time value. If you sell something that's out of the money, it only has time value. So the longer it goes above this price level, the more that time value will decay. And that's what we're trying to do. This is a bull put, when you sell something out of the money below the price. This is a risk profile. And basically what the risk profile does, and this is how I manage a trade, this shows me the max loss. In other words, I don't want to sell this out of the money put naked. I want to buy one further out of the money for protection. This is the most I can lose. And very seldom do I do that. I manage it up around here with the white P&L line. Okay, this tells me the max I can profit, the max I can lose at expiration. But the white line is what it's worth today, and this is how I follow the trades and how I manage the trades. Now, a bear call is just the opposite from a bull put. And what you're doing here is you're looking at, here I was looking at Google saying, I think this was after earnings. I think that now we're gonna come down, and the next day we sure did. And that's when you put on a bear call, and this is where you sell an out of the money call and buy one further out of the money. The example here was in April of this year when Google was sitting at 565. I sold a June 580 call, which was way up here, and bought a 590 call, which was further up here for a net credit. And what happens is when it comes down here and it stays down here, that credit evaporates to zero. Now, I never let the trades go all the way to expiration. I think there's too much risk as you get further and closer to expiration. What I'll do is I've got a target of what profit I'm looking for, and when it gets close to that profit, I will jump out. I will mitigate my risk by the amount of time I spend in the market. Now, the risk profile is just the opposite of what you saw on a bull put, but it shows you the same information. This is the max profit you can make. This is the max loss you can make. The white line is the P&L for the day. Now the iron condor matches the bull put. What we're looking at down here is the risk profile curves of the bull put and the bear call. The iron condor basically, it looks like a condor in flight. I mean, the wings are out here, and this is your max loss. Okay, this is the max profit. The nice thing about the iron condor, and the thing I look to first, is to get an iron condor, because I get both the credit from the bull put side and the bear call side. Okay, so if you set up the bull put and the bear call, you're going to add these two together and basically double your credit. Okay, what I'm going to do is take a look at the bull put, and the beauty of the bull put and why I like this vertical spread is because you have done your analysis. You feel that the market is going to go up a little bit. Okay, you can profit if the market goes up, if it goes sideways, or if it comes down slightly. Versus if you had right here on the entry point, if you had bought a call, inevitably you were right, but could have you withstood this drawdown? Well, you'll see in the vertical spread or the bull put, you actually were making money at this point. So absolutely you hung in there and got the full benefit from that. It's a less risky, more conservative approach versus buying a straight call. With a straight call, you've got time constraints. With a bull put, time is on your side. Okay. Here, when I entered this trade, and this was PepsiCo, took a very, very tight little spread here. That was a 2.5 point spread, and at that point, what we did is we sold and bought, and for that you got a 70 cents credit. Okay, if you had 5 contracts, okay, you've got a 2.5 point spread. 2.5 points times 100 shares per contract is $250, okay, 250, and the credit here was 70 cents. So the credit on the 70 cents for 5 contracts was $350. At this point, it was going in your direction, so it makes sense that you're making money. And indeed, in point 2, you were up 38%. 38% in a couple days, and then you had a heck of a pull down. Okay, and if you would have had a straight call, you might have said, I got to get out of this. Well, at this point, your vertical spread was up 2%. When you're up, you can hang in there. You can stay with it longer. Finally had a big move here. You exited with 84% of the potential profit you could have made on this bull put spread. Okay? Again, you profit when it goes up, sideways, or down. Bear call, like I said, is just the opposite. Here, if you put on the bear call, ultimately you're looking for it to go down. And if you had a put, you'd be fine here, but you'd probably have to get out here. And then I don't know if you'd ever make it to this point here. If you have a bear call, the operative word here is bear. It's a bearish strategy. Okay, selling $1.25 credit on the enter. At point 2, you were up 67%. At point 3, you were down, but you were only down a manageable amount. And then on the exit, you had made everything that you wanted to make. A more conservative trade. Okay, I only trade the big boys. The big boys are the stocks that are about $300 per share. These are the credit spreads that are worthwhile. this chart, what I'm showing you, I took bull put spreads about 43 days left till expiration, selling with a delta of about 0.10 and a 10-point spread. You can see that for Amazon, it was about 80 cents. Google, about 80 cents. Netflix, about 85. RUT, $1.05. Okay, these are the big boys. They have big credit associated with them. Here's the little guys. DuPont, Nike, Verizon, Starbucks, all around $50 to $100. And look at the credit spreads for the same criteria. 29 cents, 27, 19. There's a lot of risk here. Now, you most definitely could go ahead and buy 4 or 5 of these to get you the same amount as you do on Amazon. But why would you do that? Because why would you pay commission on 4 or 5 when you can pay commission on 1? So it makes a lot of sense to do the big boys. And these are the 4 that I focus on. The other nice thing I like about these 4 is it gives me diversification. These are all in different market sectors. Amazon, Google, Netflix, and the RUT. They're all different market sectors. So I'm getting diversification across the board as far as different market sectors. And I've got the minimum amount of commissions necessary. How do I mitigate risks? Again, I use the rate inputs of the big boys. I go with a 10-point spread. So in other words, I'm going to sell a 650 put. I've got a 10-point spread. Okay, that gives me a credit. It gives me enough credit to make this worthwhile doing. I enter about phase to expiration. I enter with an out of the money put, if it's an iron condor, with a delta of 0.10. Delta 0.10 means that you've got about 90% chance that that money option is going to expire worthless. It's a very high probability trade. If you have them on, you've got an 80% trade. I've been doing this for many years, and it averages about 65 every year, year after year after year. Now, I said take this all the way to expiration. When I reach my goal, I don't get greedy, and I get out of the market. I limit the time in the market, limit my market exposure. Let's talk about some actual trades. This is a bull put I put on last on the RUT, and here was the RUT. What is that? About 1210. 12, yeah, about 1210. I went away and I sold an 1170 put. This guy right here. Bought an 1170 put for $1.80 worth of credit. I exited right here with about 75 cents, and I took that. I got in for $1.80. Yeah, in hindsight, if I didn't just let it expire, I could have collected the whole $1.80. I had made my goal at this point. I didn't get greedy. I took my profit, got out. Now, I said I had a profit of 1,050. That was based on 10 contracts. Let me show you how I calculate and what I'm doing here. When you sell the bull put for $1.80 credit, bought it for 75 cents debit, you had a $1.05 profit. 100 shares per contract, so that's $105 per contract. With a 10-point spread times 100, that's $1,000 margin per contract. In other words, the broker wants you to put up $1,000 to put on the contract here, because they, if it totally goes against you, you're not going to quite lose that amount, but they want that in margin. Okay, to calculate the profit, I take the $105 profit divided by the $1,000 margin 10.5%. Now remember, this isn't about 20 days. This is about, okay, 10.5% profit in about 20 days, and you do this after month F, okay? So if I had 105, I had 10 contracts on here. That's you know, 1,000 hours on contracts. That's the calculations of how you determine in what you've made. Okay, here's an actual trade I did on Amazon, and that's this month. What I did was I sold a bear call, and this was after earnings, and earnings, and it started coming, look good here, and at this point in time, I sold the 470 call and bought the call for $1.36 credit. And indeed, up a little bit, then went down a little bit and kind of stayed stationary. Again, I exited at 66%, excuse me, 66 cents debit, so that was a net profit of 70 cents. I'm not looking for the whole enchilada, okay? I don't want to get greedy. I want to give what the market gives me, and I'm going to get out. Now here's an iron condor that I have on right now, and this is an iron condor on Amazon. I put on this iron condor June 2nd of this month, actually, and here what I did was I sold the 390 put and bought the 380 put, and here I bought the 490. Excuse me, I sold the 480 call and bought the 490 call for $1.70 credit. And as of right now, currently, I said it was $1. That was yesterday. That was yesterday. Today it's down to about 65 cents. So this is an actual trade that's on currently that we're in. Can I get, you know, the question is, can I get in that now? No way. No way. The train has left the station on that one, and let that one go. These happen all the time, and every month I go over these trades with the people that are in my nightly blog. And that's what I'll be talking about to you, your opportunity, in a second here. Another question you might have is, okay, this is really cool. What indicators do you use to determine whether you want to do that, whether or not you want to do a bear call or a bull put? You know, what do you use? Well, I've got a 2-hour video. In that 2-hour video, I teach you everything you need to know, how to set up your charts, what indicators are you looking at. I love two indicators. Two indicators help me to determine where the market is, where it might be going, and where should I put on my theta trades. And I will teach you those and teach you how to set up everything. This is an independent backtesting, and I give this a lot of credence because this is not me. This is one of my mentees that did this, backtested with a certain criteria on the RUT, and got out at a certain point, as per my rules, both for profit and loss. In over a 10-year period, this averaged 75% winners. 75% winners. This is one of those strategies that you just stay with it. And when it goes against you, and oh yes, it will go against you, and that's part of trading, you just have to exit. You have to know when to exit. Okay? This is consistent year after year after year. Yeah, some years are a lot lower, some years are a lot higher, but it's very, very consistent. This is a very consistent, high percentage trade. Now, the monthly return on these averages about 5 to 7%. Well, and you say, oh, Dale, 5 to 7%. I'm talking about 90%. Well, not here. Not here. This is a very conservative, very high probability trade that goes month after month after month. And where else? Let's see. Can you go into the bank tomorrow and say, I want to put my money in a CD, and oh, by the way, can you give me 5% per month? Ain't happening. Well, I think it's one of the best ways to consistently make money in the market. Question coming in, Dale, how much margin do we need to do these trades? Okay, let me go back to that. I like a 10-point spread. In other words, I like to sell something that's right here and then buy something that's 10 points away. And a one contract has 100 shares. So a 10-point spread times 100 means that you're going to need to come up with $1,000 margin per contract. Okay, $1,000 margin per contract. And then what you're going to do is month after month after month, you're going to get on average about 5% return on that month after month. It's an awesome strategy. You say, well, that's a lot of money to put up. Yeah, but that as long as you have that in your margin account, that's all that's necessary. It's just the margin required. Will you ever lose that amount? No way. No way. Well, if everything drops to zero, possibly. But you remember when I showed you the risk profile, and when we buy one deep out of the money, we're doing that for protection. If everything dropped to zero, for some reason, a lot of people are afraid of catastrophic things. This guy right here, the one that you bought further out of the money, protects you from losing any more than that $1,000 margin that you had to put up. Actually, you'll lose less than that because you'll make all this. So it's a very conservative trade, and if you're worried about catastrophic failures, this is what you want to do. Okay, a couple questions here. Do you show how to buy and sell steps in the options in your trading? Absolutely, absolutely. It's 2 hours of telling you exactly what I do. Now, this strategy is very simple. It's a very simple strategy, but it took me years to master it. And I think with my help, since I've been doing this so long, with my help, I can bring you up that learning curve a lot quicker. But yes, in that 2-hour video, I'll tell you exactly what I do, when I buy, when I get out, why I do it, what charts I'm looking at, okay? Okay, how do you determine the short strike? Okay, Sil, going back to the short, determining that. Let's say this guy right here. How do I determine which one to get? I always go with a delta of 0.1 out of the money. A delta of 0.1 out of the money. Every once in a while, what I will do if I see it moving, let's say I see it heading on down and all the indicators are saying to me, hey, this baby's going down. This baby's definitely going down. Well, first of all, I don't have tomorrow's newspaper, so I'm going to protect myself. But if my indicators are telling me that and I do it, okay, sometimes I'll bring this a little bit closer down and go with the delta of a little bit higher than 0.1. And that increases my return. Well, it also increases my risk-return ratio. But sometimes I'll do that, but for most times I'm looking at a delta of 0.10 to set my strike price. Okay, Raj, do you teach how to read the probability charts? Absolutely. I'll show you how to read the risk profile. I'll show you how to look at not only the delta. See, way back when I used delta but nowadays they actually show you probability of expiration, which is very, very close to delta. Very close to delta. I'll show you all that. Absolutely. Okay. Um, One thing I didn't show here, and I don't have a chart, is last year I took what I called a double up challenge, and like I said, I teach this, but also I do a nightly blog, and I took all the quote-unquote recommendations from the nightly blog and kept records of those. Started with a $25,000 portfolio. At the end of the year, it was worth 57. No, it was worth more than that. It was worth more than that. I think I forget exactly. I made 153% in a year. It was, but that was an exceptional year. That was an exceptional year. Do I do that all the time? No way. And not only that, this is only a small portion of my portfolio. I've got other strategies that I use. I not only diversify in different stocks, I diversify in different strategies. Question about the learning curve. Everybody's going to learn this at a different rate. Like I said, it's an easy strategy to put on, but it's hard to master that, and everybody's going to come up that learning curve a little bit. Some of them you might grab it really quick. One thing I like to talk about is let me grab my pen here for a second. One thing I like to talk about is when you first start out and you learn this thing, then put on paper trade. And if you're starting to make money on paper trade, then put on real money. If you're starting to make money on real money, then try a little bit more and a little bit more and do this learning curve. If you're learning it and you put on paper trade and you're losing, don't put on real money. Go back to the beginning. Learn, practice, put on paper trade. No, still losing. You're not doing something right. Learn. Now you're starting to get it. Now put on some real money. Now put on some more. What are you doing wrong? Okay, that's the way you want to manage this thing. You want to manage your learning. You don't want to take what I'm saying and look at this thing and say, okay, I'm investing all my money on this next week. You're going to lose. You're going to lose that. You got to take your time. You got to learn this. You know how long it takes to be a brain surgeon. Well, I hate to tell you, this is not an easy way to make money, and it's going to take time. Use the RUT index. How about other things like NDX? Absolutely, yeah. You can use the NDX. Some people use the SPX. They're both big indicators. They both have nice credits. I started using the RUT many years ago. I kind of liked the credits I was getting, and I've kind of stuck with it over the years. But absolutely, you can use the NDX, the SPX for sure. Okay. I give Dr. Van Tharp a lot of credit. Dr. Van Tharp worked with me many years ago. He's a psychologist, and he's written the book Trade Your Way to Financial Freedom. He helped me to work on my ego, getting my ego out of the way. He helped me to get disciplined, to look at expected returns, to follow the rules, all the things you need to do. And from his book, I just wanted to talk about some of the things from his book. He talks about financial freedom. Don't we all want financial freedom? Financial freedom is really a new way to think about money. Most people think they win the money game by having the most money and the most toys. Think about why you're doing this. What is financial freedom to you? Financial freedom means that your money is working for you, makes more money than you need to meet your monthly expenses. That's the classic definition of financial freedom. That doesn't mean you won't spend hundreds or even thousands of hours building the foundation you need for financial freedom. It does mean, however, that financial freedom is possible once you lay the groundwork. And this is something that I live by, and that's, do you want a large amount in the bank? You know, a lot of the financial planners will say, hey, before you can retire, you need to have this much in the bank. How about if you have a good amount of money in the bank, but you can make consistent cash flow from that? Wouldn't that be even better? Okay. Can we have access to the recording of this, Reed? I'm almost sure that they are recording it, and anybody that signed up for the webinar will get a copy of that. Okay. How do you manage the bid-ask spread? Good, very good question, Val. Because this is a four-legged trade, especially if you're doing the iron condor, okay? You've got bid-ask on all four legs. I always put in the spread with a limit credit order on, and that's usually right at the midpoint of all four legs. And most of the platforms will tell you what that midpoint is. And therefore, sometimes it's going to take longer to, I mean, this is not going to be an instantaneous fill. This is going to take you a little bit longer than most to get your fill, but it's going to be well worth it. Now, I've had an order in on the RUT for a couple days and it hasn't gotten filled. And finally it did. Okay, but I was not going to put it in at market because that's just not what you want to do. Okay, so how do you learn more? Okay, Chris, you're perfect. What does it cost for your 2-hour video and newsletter? I don't do a newsletter. I do a live video blog every night. And that live video blog is done Sunday through Thursday night. And I talk about my trades. I talk about not only the theta trades, the selling premium that we talked about tonight, but I also talk about how I'm trading the weeklies and how I'm looking at directional calls and puts. And this is, I'm showing you my charts. I'm showing you why I'm doing it. I'm showing you when I'm going to enter and why I'm going to enter. I talk every night about how I'm managing the trade, and I talk about exiting the trade. Okay? And all you have to do is go to www.optionsinfinity.com. It's $49 a month. $49 a month. You will get the 2-hour intensive course that tells you everything I'm doing. And then you'll get, it's like looking over my shoulder as I trade the markets, and I've been doing this for 35 plus years. I am a professional. This is how I make my money. But I'm getting to the point where I love to teach other people how to do this. That's how I get my kicks. Okay? The nightly video blog, you can see my charts, you can see why I'm doing them. It's usually about 10-15 minutes a night. Sunday night I started out and I get you ready for the week, and tonight, Thursday night, is when I finish up. So it's just a great opportunity. I've got a 30-day guarantee on that, and so you can get my 2-hour intensive course and go away after a month. Good luck. But the percentage of people that leave is almost nil, because what they get from me in a month, as far as profitable trades, they come back month after month after month. I've had people that have been with me for 10 plus years. They just, it's worth it. I mean, I'm not trying to gouge people. I mean, for $50 a month, I'm going to give you some very, very valuable information. You're going to look over my shoulder as I trade the market. Reed, that's what I got today. I don't think I've got, well, hold on for a second. I've got a couple other questions here. Do you do very many directional calls and puts? Tom, I think probably if I were to go back and look at it, I probably do, I think last year there were like 89 directional calls and puts. See, I only look at a market basket of about 15 stocks that I consider financially strong stocks. They're all right around $50 a share. There were about 89 of those, and there were about 20 of the theta trades. So the majority of the trades are directional calls and puts, yes. What about ETFs like SPY, IWM? No, I don't use the SPY and the IWM. The IWM is the baby brother of the RUT. The only problem is for one contract of the RUT, I would have to buy 10 contracts of the IWM. Once again, why pay 10 times the commissions you would for one contract? So I stay with the big boys, However, on my nightly video blog, I do talk about trading the weekly options, looking at things like the SPY, GLD, TLT, okay? Do you do leaps, buys and calls, selling against them? I do not, Kenny. I always look at the near-term month, about 40 days from expiration. That's what I always do. Are you able to share these 15 stocks? Absolutely. In the 2-hour video, you will see those, and then every night on my watch list, every night watching the nightly video blog, you can see what those 15 stocks are on the watch list. Okay, and every year I change these. But they don't change very often. You know, maybe out of the 15, I've got 3 or 4 that drop off, 3 or 4 that come back on. And you need to know them since I have my own favorites, and that's fine. You know, I don't want, if you got your favorites that you follow, that's all well and good. That's why I follow the 15 stocks. These are the ones that I know. I could close my eyes and tell you what the chart looks like for all these 15 stocks. I don't need to look at all 7,500 publicly traded corporations to come up with trade opportunities. Neither should you. But I'm not saying that you shouldn't look at the ones that you are familiar with. If you're familiar with something, keep it in your portfolio. What about the liquidity, the SPX, the RUT, the open interest of the SPX and the RUT is very high. A lot of the large institutions use this for hedging, especially the SPX. And even at that point, if you go in with an iron condor, sometimes it takes you a while to get filled, even with that large open interest. So if you go in with a regular stock, not only are you going to have to pay more commissions, it's going to take even longer because you don't have that open interest. How long are your nightly blog sessions? About 10 to 15 minutes. 10 to 15 minutes. Do you publish all your trades for 2014 and 15? 2014, if you go to the website, www.optionsinfinity.com, you can see all my trades for 2014. Every single one. Okay, you see the ones for 2014, Kenny, that's good, but not for 2015, because I took the challenge in 2014. I don't have the same record in 2015, I'm sorry. But I think when you look over the trades of 2014, it's going to give you a good indication of who I am and what I do.
Dale, we're actually out of time.
Do you advise how and when to adjust the credit spread? Okay, Reed, let me just finish this one question. Do you adjust the credit spread when it goes against you? I do not. I'm of the thought process that I'm either in or I'm out, and if it goes against me, I'm out. I don't adjust. In my mind, that's throwing good money after bad. And that is all the time I have today. I've enjoyed answering these questions. I hope you all at least give me a try. I mean, 30-day guarantee to listen to a professional and watch him do his thing.